The market turmoil of the past couple of years and continuing uncertainty has driven investors back to the basics of the valuation process. As a result, analysis of the economy, industry and company drivers have become more important. That's emerged from PricewaterhouseCoopers' latest Valuation Methodology Survey. Joining me to take us through the survey is Jan Groenewald, Valuation and Strategy Leader at PWC Corporate Finance. Jan, thanks for coming in this afternoon.
Afternoon, Steve.
Tell us about the survey. Who do you talk to and why the need for it?
I think the survey summarizes the view of about 27 of South Africa's leading corporate finance houses, investment banks and accounting firms. And the real purpose behind the survey is to provide people doing valuations in the South African market with some background towards about the approaches that are being used, some of the key assumptions that professionals put into those valuations, and provide some of the market data that's often scarce in the African market when we compare ourselves to the developed UK or US markets.
How have these assumptions perhaps changed, just given the global crisis of the past couple of years, now the fact that we're coming out of that crisis? Are you valuing things differently?
I think there's a couple of parts to that question. The first is really how do people perceive company performance going forward? And what we tested in this year's survey is really a view from the market around when the recovery is coming through. On that topic, we've noted most of our participants, around 70%, had quite a conservative view and viewed a meaningful recovery to really only start within 2011. And we treat that view with a little bit of substance, as what our participants are doing out there is really looking at cash flow valuation forecasts on a daily basis. So in general, the first thing we've seen is a little bit of conservatancy in cash flow forecasts from most of the corporates into 2011, and only a meaningful recovery after that. And that would be the first part. The second part that we've looked at is really the view that investors are taking towards risk in the market. Has the credit crunch really changed the way that we price in risk into our corporate valuations? And it was interesting for us to note that the investors have really taken a long-term view, and we found that the majority of our respondents actually didn't increase their risk premium or up the rates of return that they're looking for in their company valuations, but took a longer term view to say that effectively we would go through this crisis, and once we through it, we would see a more normal equity market and had a view of a long-term equity market as opposed to being too influenced by short-term fluctuations.
Well, just taking a look at that more conservative view, do you think it's probably quite wise, just given from where we have come and the fact that people weren't conservative enough in the past perhaps?
It's a good view to take, and I think we always encourage our clients and our colleagues in the practice to have a good look at the forecast, take a conservative view to it. And it's probably a fair comment to say that given where we've come from, a little bit of a conservative view for the next 2 years is probably warranted.
Well, you do say in the commentary accompanying the release today that there was a bigger response from participants than in previous years, more questions asked as well. Do you think this could be a precursor to M&A activity, more corporate activity in the market?
I think more corporates are thinking about activity, and I think it's an indication that more people are starting to look again at acquisitions and look at a more active acquisition market. And I would suggest that the way that people are thinking about it shows that they're a bit cautious after their experiences over the last 2 years. But definitely the lid is off and people are starting to look again at possible growth through acquisitions.
Of course, there has been a big focus on fair value. Did we lose sight of fair value perhaps in the past, and that's why it's coming back into focus now, that you need to know what the fair value of a company is?
I think in certain circumstances that question, that perception is probably true, that we lost sight of what the real meaning of fair value is. And we found in the survey that there's definitely a return amongst our respondents to a back to basics approach, and really looking properly at the economic fundamentals behind investments, whether it's a financial instrument or a company or a share, and really getting to grips with the economic fundamentals behind it and looking at that carefully before you make an investment decision.
Do you think that's going to make investment decisions more difficult to make as we go forward, that companies will continue to be quite cautious before they take that leap?
I think it is definitely an indication that over the next 2 years we'll probably find a very cautious market when it comes to acquisitions and new investments, and probably a little bit more thinking being done around the valuation process and about acquisition opportunities.
And maybe less overpaying as well.
Well, hopefully that's the outcome that we'll get to.
Well, there were a few questions that arose from the survey: the extent of the downturn and the likely recovery, changes in the equity market risk premium and risk premium demanded by equity investors in the environment, and also the impact of the crisis on the cost of capital. How did you respond to these?
I think what we found is that we definitely found that the recovery is going to take some time, as I mentioned earlier. From the more fundamental cost of capital approaches and assumptions that make up our cost of capital, we found that the majority of assumptions took a longer term view, as I mentioned earlier, and we found that there was a back to basics view and that there wasn't too much change after the economic crisis. What did change is perhaps the view to debt, where it's well recorded that there was a scarcity in the market, in the debt markets after the crisis, and we found that participants were a little bit more cautious when they get to their cost of debt assumptions, perhaps paying a little bit more, looking a bit harder to fund your transactions, and that came through quite strongly in our return analysis that we've done as part of the survey.
Another question that has arose is how companies address cross-border risk. How do we address that? Has it become riskier post-crisis?
It's an interesting topic for debate because one of the questions we asked our participants is whether South Africa was more or less affected than developed and developing markets. And what's interesting to note is that by far the majority of our participants, around 74%, felt that we were less affected than our developed colleagues in the UK and the US. While in Africa or other developing markets, it was more or less an equal split where people said we were equally affected or even slightly less affected. So it shows you that in the South African market, investors are a little bit more bullish and we didn't feel the worst of the credit crunch. And that gives us a little bit of gives the South African investor a bit of confidence as it goes into Africa. What is clear from the survey though is that when you start looking cross-border, that the level of analysis and the depth of analysis that you're required to do is just deepened when you start looking outside of your familiar markets and your familiar territories, and really involving local specialism, etc., has come through very strongly in the survey.
How about perceptions of risk in our own markets? And of course we have ongoing talk of nationalisation, which of course the government has rebuffed, but that talk is still there. Did that arise in the survey at all?
It's not a topic that we cover specifically in the survey in current conditions, but we have found on some of the economic research that we did around the survey that there's been a slight increase in the perception of risk in South Africa, as is viewed by looking at a South African bond and the premium that we trade in towards, for example, a US bond. But it's been very small and very moderate, and as you recall, the recent bond issues from the government was favourably priced. So it doesn't appear that there's a huge increase in the risk profile of South Africa compared to our peers in developing markets or even developed markets.